And welcome to another live hotel underwriting session. This is Danny Gould with Gould Capital. I'm going to give a few minutes here for us to get synced over to um, all of our different streaming platforms. It looks like we're not live yet on LinkedIn, so I want to make sure that we're live there before we get rolling. And so we will go ahead and hang out for a few seconds until we are live on LinkedIn. What you see here in front of you is our Gould Capital model or underwriting model for hotel assets. And we are live on LinkedIn. Awesome, cool. So, all right, everybody. This is Danny Gould with Gould Capital. I am really excited to be underwriting this particular hotel today. This is, again, for those of you who are new to these sessions, these are hotels that I've looked at a couple of years ago at this point, maybe 18 to 24 months ago. So the financials, the STAR report, all that, they're going to be a little bit outdated, but that's because I signed NDAs, so I don't want to give away anything that I'm currently looking at. Just not really worth it for these sorts of things, right? This is for educational purposes only, for you guys to kind of see how I view things, how I look at things. So we're going to get rolling right into it. This is a Hampton Inn in a tier 2 city in the Midwest. It is a major city, so I would say, I wouldn't consider it a tier 1 city just because of the population, but it is a major city in the Midwest. Good demand drivers there, and as a Hampton, it's a limited service hotel, so there's going to be good demand drivers that kind of support this hotel. So from a demand driver standpoint, I do believe that there are enough demand drivers in the market to to drive hotel occupancy for a Hampton Inn. Let's see. So we're going to go ahead and get right into it. And this one here, actually, it's so funny, is I completely forgot to figure out what the asking price was on this particular hotel. Isn't that so funny? So I'm going to go ahead and figure that one out real quick. And while I do that, oh goodness, that's so funny. I thought I was prepared, but clearly I wasn't. Let's see I want to know what they were asking for. Yeah, so they were asking for, I don't know that we have that actually. That is so interesting. Where are they? Okay, well, we can just figure out what it's worth to us. How about that? I think that's what we'll go ahead and do, because I don't see the offering memorandum in my packet. So that would be where the pricing information is. All right, well, we will go ahead and underwrite this then. I'm just going to put a purchase price of, say, I'm just gonna make up a purchase price of 10 million, okay? And then we can reverse engineer here. You'll see why I did that in a second. Okay, so brand application fees for this one probably gonna be around 150 or so. So we can go ahead and put 150,000. Broker fees on this one were going to be around 100K, I think. We'll go 150 just to be safe. Due diligence costs would be another 100, and closing costs, we'll go ahead and put another 100,000 in there. So all in there. Now, we have our STAR report, and looking at the data, we've got our ADR at 106. We're running above comp set on ADR, below comp set on occupancy, and RevPAR is just a little bit over, uh, the comp set on RevPAR. So all in all, I would say there's not a tremendous amount of juice that can be squeezed out of this. As we'll see in a second, though, there is, I would say, a medium-sized PIP that needs to be done. PIP meaning renovation. So with the reno, we might be able to bump ADR a little bit more. I doubt that it's going to drive occupancy any more than we're already seeing. I mean, we might have a little room to go up. You see, we've got 56 versus a 59 occupancy. So there might be a little bit of room there. But again, we're already charging above market rate. And if we're going to push ADR even more, I don't know how much more occupancy the hotel is going to be able to drive. So anyways, you'll have to forgive me today. I am super foggy. I have not had enough of this yet. So I'm going to keep on stimulating the mind a little bit with that as we go. So ADR, we're at 106. Occupancy, we were at 56. And the market's at 59. Okay. Keys. We are at 80 keys. Yep. 80 keys. For a limited service Hampton in this market, in a tier 2 city like this, exit cap on this, given that, excuse me, we will have a PIP done by year 2. I'm gonna go 10 cap on this just to be super conservative. We might be able to bump it down to a 9 cap. Okay. And there might even be some comps in the 8s, but I don't want to bank on that. I think a 10 is very conservative. It's conservative enough. So P&L, what's our F&B revenue? We've got literally $0 F&B. And miscellaneous revenue, we've got our T12 shows around, we'll go ahead and say 14,000. Okay. Okay. And we've got our select service, limited service, same thing. Okay. Our margin should be around 30% after replacement reserve. And so that's fairly standard. It's a fairly standard estimate. It'd be great to be higher than that. But if this hotel is performing lower than that, then we know that there's probably some juice left to squeeze. Wichita is not I just said it. The city is not an expensive market to afford labor in, and so because of that, I think that we're going to be safe, right? And pretend like I didn't say that. I said nothing. Anyways, so this one, it's not an expensive labor market, so we shouldn't see like rooms expenses being a lot higher than normal, or A&G being higher than normal. These are all things that should be, at or slightly below where our projections are, like our estimated projections are. So 30%, we might even be able to get a little bit higher than that, but 30% is like a pretty conservative and safe estimate. Down payment, we're projecting a 40% down. Could go a little bit less, 35. Doubt we could get a 30%, but let's just go ahead and say 40% equity to be safe. And we're amortized, we'll just say over 25 years. And none of this really matters here. PIP. Okay, so we got a full PIP estimate, right? And the PIP estimate comes out to about 25,000 a key. So we're gonna say 2 million just to be safe. And maybe a $250,000 reserve, or say we'll call it a $200,000 reserve. Okay. Now let's come over here. Good news is there's multiple Hamptons in this market, so we still don't know. All right. Rooms expense. And this is, we're going to do a little bit of math here. Okay. And we're actually going to go, oops. Shoot. 10 divided by. What is going on? Okay. As we these are all percentages. Excuse me, guys, as we go ahead and just get this tidied up here a little bit so that we can read it. We are at our rooms expenses around 31%. This is high. This is higher than we would expect it. So as an operator coming in, we'd see, all right, we're at 31 right now. This obviously impacts the value of the hotel, but this is a good thing because it shows us, all right, there's room for us to improve. We know that we could probably get it closer to 24, right? We could probably get it closer. It's a limited service asset. We shouldn't be running at a 30% margin. 30% rooms expense. We just shouldn't, right? This is 31 is way too high. But we are going to just put this in here. It's a 30.8. Okay. And our F&B doesn't matter because we have nothing there. Our other expenses were at 5,000 divided by 15, so we're at like 30%. We'll call it 40% just to be conservative. Our A&G. See, again, this is one thing that stood out to me the first time that I underwrote this is like, there is some mismanagement happening. Something's happening here, right? Where we're getting, our expense ratios are way off, right? So obviously after underwriting it and after going through this exercise, the next thing that we would do is start kind of doing our due diligence and talking to, the broker, kind of understanding like where these additional expenses are kind of coming from, right? We can dig through additional P&Ls, more with a more detailed breakdown, just to kind of figure out, okay, like what actual things are driving these additional expenses, right? So it's important to know. Now IT, right? So IT, we are at 3%. Yep, we're at 3% sales and marketing plus the franchise fees. So sales and marketing plus franchise fees were at close to 16%, which is high. So franchise fees were at franchise fees and sales and marketing. Yeah, we're at literally 16%. Wow. Okay. So again, something's going on there. I can already tell like our margins on this hotel are going to be really like not great compared to what we know we could do. Repairs and maintenance were at 5.4%. Utilities, we are at 5.2. We're fine there. Taxes, 6%. And insurance is at 2. That's fine. Okay. We're going to assume 2% inflation. Oops. Thank you. 2% inflation growth. Our occupancy, again, I don't want to do too much here. We'll figure it out on the back end. And we'll say live. Oops. Okay. So here we are. Again, our total project cost right now as it stands is around 12.7. All right. So let's dig into this. Our occupancy rates. So right now we have, we're gonna a standard 7-year hold here. Right. So we're gonna try and hold this thing for 7. From an occupancy standpoint, I could see this getting to like a 59, from 56 to 59 over 7 years. The market's currently at 59. The city is growing. Okay, so there's because the city's growing, because the demand drivers support this kind of asset, I think that we could see occupancy get to where it currently is for the market for this hotel in 7 years, assuming ADR stays where it's at or grows at an accelerated rate. So 56, we are at what, 59. So yeah, we're right there. Our occupancy is right where we want it to be. Now, our ADR, we are growing it at around a 2%. Oops. Growing at around a 2% rate every single year, which is fine. I don't think that we can project any more than that. Just based off of how this hotel is doing. Like, there's not a tremendous amount of room to grow in this market just based on what I'm seeing here. And we don't want to, guys, the one thing that we don't want to do is we don't want to come up with these fake imaginary numbers that may or may not happen. Right? Like, if we want to dream and dream big, great, but not with, not with investor capital. So this is a good estimate. All right. We're already at 106. We're already outperforming the comp set by 7%. So for me, I'm like, okay, getting to 121 by year 7, that's about a 13, 14% growth in 7 years. That's pretty good. I don't think that we can project any more than that. All right. So I'm fine here. I think what we really need to focus on and where the money is going to be made on this hotel is getting these expenses down. Okay. So here, what we really need to figure out, and by the way, let's just look at this real quick. So our net margin on this hotel is 13%. We're supposed to be at 30. So we can double the value of this hotel in 7 years if the seller's willing to sell it for what it's currently worth, right? So if the seller's willing to sell it for what it's currently worth, which would be somewhere around 3 million. They're not going to sell it for that. But we can figure out, what an acceptable price would be for this asset once we kind of do some reverse engineering here. Yeah. Okay. So our rooms 30, 30, 30, 30. So what I'd like to do is I'd like to get our rooms expense to 25%, not 24. Let's go a little bit above what we know is possible by year 5, year 4, and then we'll keep it at 25. Okay, so that's what we'll do first. And I'm oversimplifying this, guys, because there's a lot more that goes into this, but like I'm just doing back of napkin, like a 30-minute underwriting here, right? If we want to do a more robust underwriting where we go through the detailed P&L, we kind of go through all the that's going to take hours, if not days. We don't have time for that on this one, right? So we're just kind of doing it shorthanded and quick. But that's okay because shorthanded and quick gives us the ability to decide whether or not this is even worth pursuing even anymore, right? Further. So our rooms expense, we're going to go actually negative 2, negative 2, negative 1, negative 1, and 0. This is fine. This is fine. Nailed it on the first try. Okay, A and G, we want to get this to 8% by year 4, and then same thing. So we'll go ahead and go. Nice. What did I do? Okay. So now we've got 12, 12, 11. No, not aggressive enough. Nope. Stop it. So this is where guys, this is where we just got to kind of play around with it and figure out, okay. And this also gives us some good, because it's like, okay, we've got to cut 5% of the departmental expenses this year. And then next year, we've got to cut another 5%. And then we've got to cut, but it gives us some good like benchmarks, right, to really shoot for. Yeah, so we're at year 1, year 2, year 3. So I think that we've got to go negative 5, negative 5, negative 5, and then negative 5. Okay, I think we should be good here. So now we're at 12, 12, 12, 10, 9, 8, 8. Okay. Yeah. Now, see, here's the thing. Even still, this is year 7. We're at a 25, 26 NOI or EBITDA minus replacement reserve. We should really be closer to 30. Now, where's the additional spread? Well, A and G is still a little high, right? We're at 8.5. We should be closer to 7. Our rooms expense is 24.6, so it's kind of right where we need it to be. But our sales and marketing and franchise fees are still fairly high. Now, I don't know, like, what could this be attributed to? They're, they could use a lot of OTA traffic, and some of the OTA stuff gets looped into the sales and marketing. OTA meaning like online travel agency. So we might be getting some of that passed in through there. The uh, loyalty program, right? So uh, for Hilton Honors, we might be getting some of that might be getting stuff. Wow, today, guys, I'm just like not there right now. Um, yeah, so with the OTAs, we might be getting some OTAs and Hilton Honors loyalty. There might be additional expenditures kind of being passed through those two line items there. That would be my best guess right now because it's not like, yeah, that would be my best guess for what's happening there. There might be an extra sales position, or they might be spending more money on some like weird marketing thing that clearly is not helping them. So, without looking at that though, I wouldn't be able to kind of figure out what, if anything, we could strip away from there. And I don't think that it would be wise for me to strip anything away. The only thing that I might be able to do, right, is say, hey, we're just not going to grow our marketing line item. And so that'll bring it down a little bit. And so by year 7, we're at like 27. I think this is good enough, right? Like, I think based on where we're at right now, 13, we're now projecting basically a doubling in the EBITDA minus replacement reserve over a 7-year period. That is aggressive enough. I think anything more is probably it probably might be worth looking at, but I don't think that we should like count on that. I think that this is attainable based on what I know is possible, but we know is possible. But anything more, I think, is just a prayer. Right? So let's go ahead and keep it where we're at. I think that this is good. We're at 60. Yeah, it's plus and honestly, I don't like this. So we got to come back here. I don't like this at all, actually. So I think that we got to come back here and we've got to adjust these 58. I think that we just got to go 59 and 59. Okay. Because the market's currently at 59. I don't think that we should project over what the market's doing right now. So, yeah, right there. 26.7. That's fine. Okay. Don't pay. This page is just a bunch of calculations. So, let's say I think, on this, assuming that we are coming in on it as an LP, um, would probably be able to negotiate like a 10% pref with the sponsor. Maybe they're doing like a 20, I'd say like a 20 over 10, maybe a 15 over 10 actually. And then a 20 over 15. We'll go 16 here actually. And then a 25 over 20. All right. Now, acquisition fee, blah, blah, there's no construction. Maybe they would charge like a $200,000 construction management fee. And I would actually bring this down to 1.5. Oops. I would bring this down to 1.5. Oops. Our asset management fee, we'd probably bring it down to like 1.5, 2, and our disposition fee would be a 0.5 point. All right. Oops. Okay. Now, what I'd want to know is, in order for us to get to in order for us to get to 22%. Huh. Wow, that's crazy. So this hotel would really only be worth about 1.6 million, right, in order for us to get to like a healthy internal rate of return. Now, if we were like okay with say high teens, about 2.3, right? So even though there's meat on the bone, unless this is a distressed asset where the seller's willing to just basically give us the keys, right? Um, to me, this is a no deal, right? And we didn't even this one didn't even make it past like the first stage, right? Like it was pretty obvious that it was overpriced. If I had to guess, the price tag was probably close to what, maybe a little bit less. Maybe I forget what the price tag was. Um, but it was definitely above five for sure. Right. So even at five, right? Like even at 5 million, let's just not 50 million. What are you smoking? Yeah, I mean, like there's just no meat on the bone, right? There's just like zero meat on the bone. Now, even if we made this a nine cap, right? So we could, but still, look, like you make this a nine cap, and oh my gosh, no, that no wonder. Oh, maybe this is what happened. Okay. Um, yeah. Okay. So maybe actually, hold on. Let's go back. I might have misspoke here. There might have been some issues with sorry, the construction management fee actually was incorrect, and it might have semi-corrupted our analysis. I mean, not really, right? Like 1.9. It's worth 1.9. It's worth 1.9, 2 million maybe. And then if we were going for like an 18%, maybe 2.7, right? But at 5 million, our internal rate of return is only 10%, right? Not good. Not good. So again, this one didn't really make it past like our first, like our initial underwriting kind of like checklist. We pretty much immediately threw this one away. But it was interesting in the sense that it was clearly not managed properly. Um, 13% margin. Let me put it to you like this: I've seen hotels in Manhattan that have better than the 13 limited service hotels in Manhattan that have better margins than this one. And Manhattan has all sorts of issues, right? Ridiculous tax rates. Uh, uh, we've got union labor, right? Everything is more expensive in New York City, and it was still higher margin than this. So that's that's mismanagement. There's just no other way to say it. Anyways, guys, this is all I've got for you on this for this particular Friday. If you have a hotel that you'd like me to underwrite, I'm happy to do it. It must be a branded asset. If we want to do a boutique, you can send it to me and we can talk about it, but I won't be doing it live here on LinkedIn or on YouTube. And yeah, this is exciting. And if you've got any questions or comments about this particular underwriting, right? Like if you got any questions about this particular hotel, like why I did, like my thought process, whatever, like I'm happy to answer those questions. You can put them in the question box or the question box down below. And that's it, guys. I will see you next week for another underwriting session.